Welcome, everyone. Happy holidays to everyone on the call. This is the Lear December 2024 Market and Strategy Update. My name is Tom Steinley, Director of Business Development at Lear. I'm joined, as we are each month, by our co-host, Head of Research and Co-Portfolio Manager, Jim Warner. For those joining us for the first time, these webinars have two purposes. One is to share our unique insights on the market and the economy, but more importantly, we want to, and what makes us different is that we want to tie these insights back to our strategy. How do world and economic events affect a client's portfolio on a very granular level? We manage a concentrated portfolio of high conviction securities based on long-term irrefutable themes. And because we own only 30 positions, clients know not only what is in their portfolio, but why they own each position. That's why we believe these client-approved webinars are so helpful. Before we get started, I just want to encourage you to ask questions and remind you to do that through the Q&A button at the bottom of your screen. And as a reminder, those questions will be anonymous. So please, there's a lot going on, and we want you to ask questions. We're here to answer them. And then lastly, I just want to remind you that we will be following up by sending you compliance-approved replay of the webinar, as well as the accompanying slide deck. So welcome, and with that, Jim, let's jump right in.
Great. Thank you, Tom, and thank you to everyone that has joined. I'm sharing my screen right now, which you see momentarily. So what we want to talk about a little bit is this post-election Trump trade, some of the trends that we've seen, what we think is interesting, what we think could last a longer bit of time. And then most importantly, towards the end, as I always do, I'll talk a bit about how we're positioning portfolios and some of the new things that we've put into the portfolio, which we're super excited about. So to jump in and look at the kind of post-election reaction, we obviously had a big rip the day after the election. Yeah, I think this was obvious. This was clearly chalked up to the fact that we had a clear winner. Trump won both the electoral and the populist vote. I think there were a lot of concerns going in that this could be a messy election and it would take forever for us to know who won. I think that put the conclusiveness of the election, I think, put the risk asset markets in a more calmer, more risk-on mood. And so we saw this big rip. And then I think that we went into this period of, okay, well, what does this really mean? What does this mean for sectors? What does this mean for the market? What does this mean for the economy? And there's kind of this initial sense that, well, there's going to be tariffs and there's going to be more deficit spending, so therefore higher interest rates. You saw a big move in rates. You also, and we'll get into some of the other trends in more detail here, but ultimately I think that was, it caused a fade in that initial rip, and then we kind of got back on essentially the bull market ride that we've been on all year, or really for the last 2 years. And I think that's as folks started to digest the picks for cabinet, which we'll go through. I think ultimately that alleviated some of these inflation fears, and I think the attitude and sentiment shifted more towards the pro-growth, lower deregulation, lower tax policies that Trump is likely to be able to enact, given that he has also a Republican-controlled Congress. So the other thing that we keep pointing out to people is that every dip in this market is getting bought, and there's a lot of good reasons for it, but there's $7 trillion of cash sitting on the sidelines. So we've consistently seen any sort of weakness in the market as an excuse for people to move out of cash and into stocks, and in some cases bonds. So we think the bull market is intact at this point. And as we sit here today, the S&P is up roughly 4 or 5% since the election. So that's been a really healthy move for risk assets in the month of November and as we head into December, which, by the way, is usually a pretty good, seasonally good month for stocks as well. So as we've been saying for the last few months, we expected this rally to continue through year end, given some of these positive seasonality effects and the underlying strength of the economy. So digging a little bit into the specifics of the Trump trade, which really was a bit more muted than I think a lot of people expected. What I did here is I took and I graphed Bitcoin, which is that top line, against some of the other more Trump trade ish industries. The big winner here is obviously Bitcoin, which is up 40% since election day, and it's continued its upward trajectory. I mean, it's kind of tapped out right now, but underlying that, of course, is Trump's more favorable view of Bitcoin. And we've got an exciting new addition to the portfolio that is somewhat related to that I'll talk about in a little bit. But what this does in some ways is it takes off the table the potential that we always thought was there for the SEC or some regulator to step in and really mess up the Bitcoin market and the crypto market. I think that this implies that there's going to be a lighter touch. And so you've seen Bitcoin really be the big winner in this election trade. Moving down to these other lines, this next one is the regional bank KBE ETF, or it's the banking index. And there is this thought that there is going to be less financial regulation under Trump. We really have no indication to suggest that that's right or not. And so you've seen this be kind of a muted move, kind of a big rip on day one and really kind of flattish thereafter. Similarly, oil services, represented by the OIH ETF, again, saw kind of an initial surge, the whole drill baby drill thing. And then I think reality kind of kicked in to some extent. It's not as easy as telling oil executives and natural gas executives to just turn on drilling. So I think, the market's been fairly rational, and it's been even rational towards the sectors that arguably could be most hurt by Trump, or at least where you would see rotation away from. So the SMH, semiconductors, not that there's any Trump policies that necessarily would impact that, although maybe tariffs if you squint, and gold obviously kind of took a bit of a backseat as well. But even those moves, whatever losses were incurred, have essentially been mostly recovered. So all in all, kind of muted. And I put that slide on because all leading into the election, everybody always asks me like, well, what's going to happen to sectors? And very rarely is there a very clear winner or loser. We'll go into some of the potential losers here in a minute, but Bitcoin was really the only clear winner here, and everything else has been relatively muted. Now, why is that? Well, it's because we have to rewire our brains back to the 2016-2020 period, and where the Trump rhetoric is often very different than the reality of what actually gets implemented. And I think people are picked back up on that, I think, fairly quickly during the month. And this is true around what actually is going to happen around tariffs, what actually is going to, there's probably a pretty good chance that the tax cuts will get enacted, but to what degree, and is there a compromise, particularly at the upper income level? It's a very tight Congress. It's not, the Republicans don't hold it by a wide margin. So there's going to be some compromises most likely, but again, a little muted, little unclear as to how that's going to turn out. There's going to be some government cost cutting. We'll talk a little bit about, whether or not that could be material or not. The drill baby drill, it's not as easy as you think. Make America healthy again. We'll talk a lot about that in a minute. But, how does that actually get implemented? What does that mean for food manufacturers and vaccine manufacturers? And then digital currencies. All we know is that Trump likes them. So, again, it's always important to separate out the rhetoric, which tends to be more effusive and hyperbolic than, from the reality of what actually gets implemented. So, to think about what could get implemented, I think it's important to look at the cabinet picks. And the selection or the nomination of Scott Bessent to Treasury Secretary was really a great one from a market perspective. And you could see the moment he was announced, the stocks and stocks went up a bunch and interest rates declined. Why? I think generally, number one, he's an expert in global macro. He's been a hedge fund manager for 30, 40 years, and has worked at the biggest and baddest hedge funds out there, and has got a finger on the pulse of the world economy. So I think that's one good check the box mark for him. He also has what seems to be more rational economic policy goals. They call it the 3x3x3. So this is reduce the budget deficit to 3% of GDP by 2028, and that's while extending tax cuts. Achieve 3% GDP growth through deregulation and other pro-growth policies. That would be good. Increase U.S. energy production by 3 million barrels of equivalent oil per day. That's going to be harder to get done, but this is a framework, at least, that looks very rational, particularly against maybe some of the rhetoric we've heard during the campaign. I'd also delineate the fact that rhetoric you hear pre-election oftentimes is much different than what actually you hear after an election. But interestingly, even on the point of tariffs, the Senate seems to be a bit more moderate in using them as a strategic tool to primarily target China and achieve specific foreign policy goals. And then, right after that, you saw that night, Trump announced 25% tariffs, or threatened 25% tariffs on Mexican and Canadian imports. And what obviously Trump is trying to get after here is a secure border. And clearly, if he put 25% tariffs on Canadian imports, he'd throw that country into a deep recession. But and so it's a stick. It's like the old Teddy Roosevelt carry a big stick kind of attitude. So I think the markets really appreciate that Bissett has that rational kind of steady hand. He is an expert, and he will be in the room when big decisions are made. And I think the market takes heart in that. That all said, there could be some very significant losers, sector losers, even with that. The RFK Jr. impact should be noted. His nomination to head up Health and Human Services is very notable. Obviously, everyone knows about his Make America Healthy Again. If you dig into it, there's basically 4 stated goals. It's vaccine reform. Now, what does that take? Does he actually eliminate the safe harbor on vaccines? Does he require all vaccines to get retested? For negative effects? I mean, we don't know how this is going to play out. But I'll tell you this much: it makes it very difficult to own, a Merck or a Nova or a Pfizer, because it could very radically change their business models. He wants to enhance nutrition and food safety, as we all know. That this could mean banning harmful food additives. This could include removing ultra-processed foods from schools and other other institutions that the federal government can influence. So it's a little difficult to see what is that going to do to a Procter and Gamble down the road. These are questions that we don't have answers to right now, but that potentially could be very harmful to their business models. The chronic disease prevention is another big view of his, and so that kind of ties into, I think, all of this, the vaccines and the nutrition. And then he also wants to improve on the environmental health. And so that could lead to stricter regulations on pesticides and agricultural chemicals. Again, this could have some level of effect, negative potentially, on, the seed companies or the agricultural companies. So there's a lot of tentacles that are being reached out that into various different industries that could be potentially negative, and something that we're going to have to watch very carefully. It's been said, though, that his nomination process may be one of the hardest to get through. And so, we'll see. All this is kind of TBD, but it does create a list that I'll go into in a bit of names and sectors that are probably uninvestable for now. And then the last thing I'll talk about in terms of this isn't really a cabinet position because it's a non-governmental entity, but everybody's talking about Elon Musk and Vivek Ramaswamy's Department of Government Efficiency. And, their key stated goals are to eliminate thousands of regulations. That would be pro-growth. We'd probably expect that under any, Trump administration. Reduce the federal workforce, which, surprisingly, the federal workforce ex-military is really not that large. It's about 3 million people. So, even if you're laying off a few 100,000, it's not a needle mover for the economy at large. And then they want to reduce federal expenditures by $500 billion. I think the other interesting thing about it is there's an expiration date on this Doge, where they expect to get this done within a certain period of time. So, there's lots of conjecture on what this means. And of course, we all know that Elon Musk has probed his own level of hyperbole. And so, whether it's the Department of Education getting completely eliminated, I think at this point, nobody really knows. I think it's probably the cost cutting is going to be a bit more tactical than that. And there are laws out there that do protect some civil servants, although, the Chevron precedent and other things like that have been, they think, give them some, cover to make these decisions. But again, we have no specifics. I generally think that whatever they do is probably going to have a limited impact on the broader economy. So I hinted at, uninvestable areas of the market for now. We're avoiding vaccine manufacturers. We're avoiding companies that, will really rely on exporting to the US from Mexico, Canada, and China. We just need more information. For manufacturing more broadly, we have to take a finer scope to processed food manufacturers, agriculture, and then the removal of various clean energy subsidies or the reprogramming of them is something that we're just, happy to stay on the sidelines and see how this all goes. Now, the fact is that, as is the case most of the time, is that the market will overreact, it may overreact very negatively, and it may also include names that don't deserve to be included in this in a particular category. So take, for example, one of the names that was in one of our portfolios was AbbVie, and the stock's gotten hit because it's, a pharmaceutical company, and all pharmaceuticals have gone down. They all went down the day that RFK was nominated. And the reality is that actually fair? And, AbbVie is kind of an interesting one because they actually they have one of the largest TV advertising budgets of any drug company. And one of RFK's, desires or goals is to eliminate pharmaceutical drug advertising on television. And, would that be a bad thing for AbbVie? I mean, or a good thing? Would it actually potentially increase their margins? I mean, so some of these are very nuanced questions, but it's, over the coming, 6 to 12 months, we're going to get a number of these names that will flash in front of us as potentially being really oversold and, kind of the classic baby thrown out with the bathwater. But for now, we're waiting to get more information before we get, sort of aggressive on the long side in any of those types of names. So, but generally speaking, we're still leaning risk on. If we had to put a rating on it from 1 to 10 in our sort of flagship, more moderately risked strategy, Global Vigilance, we're probably a 7.5. And why? Because the economy is strong, labor market's still solid. You can see on the graph on the right, real wage growth is still growing. In fact, it looks like it's ticking up. That's supporting still solid consumer spending. Yes, there's places and areas of weakness, but generally all still very solid. Interest rates are headed. They're headed. If they're headed in one direction or the other, they're likely lower, not higher, and that's good. And what we're also seeing is a broadening of sector exposure. So I'll talk to this in a second, but this has been one of the difficulties of the last 2 years is just the concentration of returns in just a few names. A broadening would be a really positive thing. And then we believe that you shouldn't fight the Fed. So the Fed is right now predisposed to cut, not tighten. Now, how much? There's really not a lot priced into the market right now in terms of cuts. There's a 75% chance that they cut this month, just 25 basis points. And then next year you look out and there's basically about 3 cuts priced into the Fed futures curve. So that's not a lot. And the reason why I point that out is number one, it puts us at the market isn't out over its ski tips in terms of, aggressive interest rate declines, which it has been in the past, and that's created to corrections in the market when the market had to reset rates higher. So we don't have that problem right now. I think the question in my mind has been, has the Fed kept rates too high for too long? and have, and so it has the new path towards getting back to neutral, which is roughly around 3%. Are we doing it too slowly? That's, it is on the forefront of my mind in terms of concerns. So far, so good, and the economy still looks good, and so we've continued to see this $7 trillion of cash sitting on the sidelines. It's still there, it's still earning a great yield, but at some point they're going to have to come into the market, and that should be good, particularly if we get some dips in the market, in the coming months. And Rick and I always say that you can get a 5% dip in the market on nothing, and there's a 2/3 chance in any given year you're going to get a 10% pullback. And right now, those are actually welcome opportunities to then get new buying opportunities and deploy, more conservative strategies into slightly more aggressive positions. So that's where we are, still leaning risk on. Pedal is not all the way to the floor, but it's, most of the way. And then this broadening looks pretty interesting. So last month, if you joined us, I showed a slide where 25% of all the gains in the S&P 500 this year is from NVIDIA, just NVIDIA. And that is probably the most concentrated return pattern we've seen in the market maybe ever. Just one single stock driving, a big chunk of the market up. And so I put this graph in because that's actually no longer the case. Like NVIDIA is no longer the key driver. And you've seen kind of the more cyclical parts of the element, which I represent here with the Dow Industrials Index, as sort of keeping pace at this point. So you see this, you had this, now what this graph represents is the NVIDIA stock price divided by the Dow Industrial Index price. And that gives you the relationship between those two elements. And you see that basically when the line goes up, that meant NVIDIA was outperforming. And the line right now is essentially flattish to that prior peak, which means that the cyclicals have really been keeping up at this point with NVIDIA. And I think that's a very good situation for portfolio managers like me. It means that I have a lot more stocks to choose from. It means the market sentiment is more open to looking for value in areas that have lagged. And that could be financials, that could be energy, some of these more cyclical names that, aren't in rah-rah, tech space. So that's always good from a portfolio manager standpoint, I think ultimately for client portfolios. So one question that we get a lot is, but isn't the market expensive? And there's a lot of words on this page, but let me simplify it. With this chart on the right, the brighter blue bar, that's the PE of the S&P 500. And right now it is expensive. It's at about, a little north of 22 times forward earnings. And that's right up around the peak that we've seen over the course of the last 10 years. You can see they were well above the pre-pandemic levels that really where we normally peaked out at 18 times. So, but that largely all of that is being driven by NVIDIA and some of these big tech names that have really been driving the market and have much higher PEs than the rest of the market. So the black line is the S&P equal weight. And what you can see is it's at around 18-ish times, which, what we're doing here in the equal weight, right, is we're minimizing the impact of the big tech stocks and so what you can see is it's still at, around peakish levels that we've seen historically at around 18 times. But then again, we've traded at 18 times for, years at a time. And we sort of vacillated between this kind of, 15 to 18, historically speaking. So, while things are a little stretched, what it means is that there's more optimism in the market today that the 2025 numbers have to come up. And so that makes this upcoming Q1 earnings season, well, actually it's the 4Q reporting season, but it'll happen starting, in a few weeks in January. It makes this season very important for what companies put out as their guidance for 2025. Because the market right now is betting that numbers need to go up a bit. And that's what you need in order for the market to stay up. But right now, I don't think that there's a ton of risk to that. And so but that, if you ask me, what's kind of the next potential thing that could lead the market down, it would be poor guidance. But right now, we're just not seeing enough evidence in the economic data to warrant that. So, things generally seem to be kind of moving along in a pretty nicely, once you sort of strip out those tech stocks. To talk specifically about what we've been doing in the portfolio, we had some recent additions. Um, we've owned CyberArk for a long time, and it's quite clear that the outlook for cybersecurity remains excellent. AI hacking is now a new thing, and it is likely to only accelerate demand for cybersecurity solutions, and CyberArk is very well positioned. IRAN, which is a company called IRIS, is a new and very interesting and potentially very profitable position we recently entered. It's actually it's a Bitcoin miner, and it's actually the lowest cost producing miner that's out there. And so when Bitcoin prices are hovering right now around 95,000, they produce Bitcoin at a cost of 30,000. So they're making a really great spread as it is today. But we think that there's actually even more option value in this stock as some of these mining operations, and they have a big capacity expansion that's underway, get either leased or sold or otherwise rented out to AI companies. One of the biggest bottlenecks right now for any company trying to do AI is getting data center space. And one of the biggest bottlenecks is actually getting, once you build these data centers, actually getting connected to the grid or providing, the required amount of electricity in maybe some alternative way. And so it's adding years onto the development of these data centers, of which there's massive amounts of demand. It turns out that Bitcoin miners are very good at locking up electricity capacity. And so they may be the way for some of these AI folks to shortcut this bottleneck. And so stay tuned on that. It's going to be a fun one to watch. It's going to be very volatile. We also added some uranium and nuclear utilities. For those that have been listening to me for a while, that we've been very bullish on uranium. We think that nuclear is the way to go, and I think the Trump administration is much more likely to incentivize the development of nuclear. And so we're looking. We think that that's a great place to be. And then we've added to a very long-term position, AMLP, which is a midstream pipeline that should benefit for any sort of additional oil and gas. It'll likely face fewer regulations and that sort of thing. So we're very happy with that. It's been a great performer, and we added to that. So, but when we step back, those were great ads. They've run a lot this month, as is the rest of the portfolio. This has been a great year. The returns have been excellent. And, so I think mentally we are, kind of more likely to maybe knock off a little risk as opposed to add. But, we are always, as tactically adjusting the portfolio based on what's going on in the world. But, I think as we stand here, we've got some names that have just, really had big runs. And so our kind of knee-jerk first reaction is we might want to be taking a little risk off, heading into the new year or beginning of next year. The other thing that we've talked about in the past is we talk a lot about yield curves, right, and how we're positioned in fixed income. And I think we've modestly changed our view within the last couple months, where if you look at this yield curve on the right, and it's a little bit, the y-axis is a little dramatized just to make the point, but you could be at the front end of the curve and make anywhere between 4.75% Fed funds rate to the 4.6% 1 month, or you can go way out the curve. You go to the 20-year and make like 4.46%, but you're taking on a bunch of interest rate risk, inflation risk, et cetera, et cetera. But a lot of bond funds, like a typical total return bond fund, is sitting in what I'll call the belly of the curve, this 5 to 7 year type area. And so same with a lot of corporate bonds. And there's value there, but there's a lot more value to be in these shorter durations, closer to the 1 month and 3 month. And so I think one of incremental changes we've been making to portfolios over the last couple months is just sticking a little bit more towards the short end of the curve. It gives us obviously firepower if we want to, deploy it into equities on a dip. But it also gives us just a nice yield and, very little principal risk. So, we're very happy to be at the short end. And, as things start to evolve and we get a better sense for what deficits could look like, or what the direction of inflation, in particular, if, tariffs are having an impact, whatnot, then I would say with more information, we go way out to the end of the curve. But I think we're going to need to see a much more inverted curve before we, kind of wade back into the belly of the curve. So I'll finish on this, and then I'd love to get your questions. So just some thoughts on 2025. Could it be another big year for stocks? I mean, we've had 20+ years in a row. Some people I've heard some talking heads say, well, it's very rare that we have, a third. And I think it's important to kind of look back in history and maybe see where we are relative to maybe another point in time. And if you go back to the last time with the economy was coming off of a surge in inflation, you're basically back to 1981, when that was the last big surge in inflation. And as that inflation was being worked off, you saw big returns in the market. And so you saw like the big return in 1982 and 1983. And then we got into, there was a little bit of a pullback, but still positive in 84. And then you started to see the kicking in of the Reagan era, lower deregulations, lower taxes, and all of this combined with lower declining inflation. You had lower interest rates, and it was just a very good time for risk assets. I don't know if we're in this kind of an environment, but a lot of the key drivers are similar to the environment that we're in. And the ultimate result was lower unemployment, higher GDP growth, higher stock market. As all those things fed through into corporate earnings. So, my point is that it's, you never want to take just a couple of data points and extrapolate. But so far, everything seems to be on a decent footing. So that's the end of my prepared marks. So Tom, let's see if we have any questions in the queue.
Yeah, great, Jim. As always, thank you. Yeah, there are a couple in here. The first one is, what are your thoughts on real estate over the next couple of years?
So, well, let me take it in two parts. There's commercial real estate, and then there's residential. Let me take residential first. Depending on where you are in the country, things could be very bad. Right now, things are very bad in Florida. The combination of factors: very high prices, high mortgage rates, low affordability, surging property insurance rates, et cetera, right? It's very difficult. You're seeing huge price corrections in a lot of cities in Florida. You're seeing some of that in some of the other areas of the country where you had big surges of population due to, during the COVID lockdown years. So parts of Texas, Salt Lake City, various different, vacation places where, people piled in and worked from home. So you're seeing some stuff. There's other places that are healthier, but right now we've just had a big surge in prices. I think prices are generally coming down. I think that's actually a very positive thing for the headline inflation numbers, because shelter is a big component of it. I think you're gonna kind of continue to see a kind of dragging down of that number. So that's my view on residential. On commercial, again, it depends. I mean, Class A really good buildings aren't really seeing too big of a problem, but then it drops off dramatically from there, and it is rather ugly for Class B buildings, particularly in very urban areas. Very urban areas that have been hit hard by the pandemic. And so, honestly, we're actually getting pretty interested in what's going on in the prices of commercial real estate in New York City. And I would include office and multifamily in that comment. And actually, I've been invested in a bank that we think has a clean balance sheet, has marked their balance sheet pretty clean, and that's actually one of our favorite ideas. So, but again, it's a bit of a kind of a non-answer, but it's mixed. It depends on where you are.
Great, thanks. So here's another question for us, Jim. Why have gold, LNG exporters, and MLPs all outperform the S&P 500 while being low correlated assets in your portfolio? And do you think this will continue?
Yeah, so that basically means they've generated a ton of alpha, and that's really our goal, is to find assets like that will generate great returns that are not very correlated to the market. Each one of those, well, I'd say the LNG and the MLP are somewhat similar in the sense that there's this massive need for LNG in Asia and Europe. As they move their in places in Asia, there's still growth, a lot of growth in electricity generation, but everywhere in the world, there's sort of this general shift from dirty, coal energy to cleaner natural gas. And LNG, Cheniere Energy, we've owned it for years. They are the leader. There's been we've been waiting for it. It was kind of a laggard for most of this year until I think the market wisened up and realized just how much new capacity was coming online this year and next. So we're delighted that that's working. That's been a great position. AMLP, that's a great position because, again, the natural gas has to go through a pipeline to get to Cheniere so that they can gasify it. These are just steady Eddie contractually based cash flows that generate really nice dividend yields. That's kind of they are kind of a very often found common thing to hold in our portfolios. Gold's a little bit different. Gold strangely did not increase in value when we had mega inflation, and that we thought was just bizarre. And so, I think we thought that was kind of an interesting, reason to get in, because it just didn't seem to match what was happening on the ground. There is a very fixed supply of gold. There's also a lot of central banks that are starting to buy gold, and so that's creating some pretty nice demand for it. Yeah, we expect a lot of the trends for each of these three to continue into next year.
Great. Okay. So you had mentioned that performance has been really strong this year. Can you attribute the outperformance to any particular part of the Lear investment process?
Well, I mean, I think it's very difficult when you have an up year, generally speaking, in the market. It's very easy to confuse yourself from being really good. But we have had a lot of outperformance relative to the market, and I think I would attribute that to our general process, which is understanding how much risk to take in the portfolio. We have sort of dialed up the risk as the year has gone through, and I think that's been helpful. The other is we are big believers in investing based on secular themes. So we've been involved in AI for a while. It finally really turned on this year. We've been involved for a while in what I'll call electrification, kind of the build out of data centers and the various things that go into that. The world kind of turned itself onto that as well. I mentioned there are some idiosyncratic opportunities where whether it's an LNG, where we sort of get there and we hang out and we wait, and the market finally figures out what we know and comes in behind. So yeah, we've done some good stock picking. I think we've done some really good selection of secular themes, and we've been willing to buy dips, and that's been important and informed by our macro process.
Terrific. All right, that appears to be all the questions in the Q&A queue at this point. If we'll hang out another 15 or 20 seconds, but assuming that there are no more questions, I just want to thank everybody for joining us. I want to wish everybody on the call a very happy and productive remainder of 2024, and look forward to talking again in January of 25. Thanks and have a great day.
Thanks, everyone.